You deposit your paycheck. You see the number appear on your screen. And in that quiet moment, it feels settled, safe, yours. Here's the uncomfortable truth. The second that money hits your bank account, it stops being yours in the way you think it is. Not stolen, not scammed, not illegally taken. Something much stranger happened, and almost nobody is told. This matters right now, because more people than ever are living paycheck to paycheck, trusting digital numbers, trusting institutions, trusting that money in the bank means security. But the system underneath that feeling was designed decades ago for a very different world. And once you see how it actually works, the calm illusion starts to crack. Let's slow this down. You work, you earn, you deposit. Common sense says the bank is holding your money for you, like a locker or a vault or a digital safe. That's not what a bank account is. Legally, the moment you deposit money, you are no longer the owner of that cash. You become a lender, and the bank becomes the borrower. That's not a metaphor. That's the legal structure. Your bank balance is not your money stored. It's an IOU, a promise that the bank owes you that amount, payable on demand. That subtle shift changes everything, because once the bank owes you money, it's allowed to use it. And it does. Your deposit becomes raw material. It's pooled together with millions of other deposits and sent back out into the world as loans, mortgages, credit cards, business debt, government bonds. Your money doesn't sit still. It works for the bank. Now here's where it gets interesting. Most people imagine that banks lend out the exact money deposited by customers, as if there's a neat chain from your paycheck to someone else's loan. That's not how modern banking works. Banks don't wait for deposits to lend. They create loans first. When a bank approves a loan, it doesn't pull existing money from a pile. It creates new money digitally, out of nothing but a promise. That loan becomes someone else's deposit. Money expands. Then reserves are adjusted afterward. This system is called fractional reserve banking. But that name is almost too polite for what's really happening. It's controlled multiplication, and it only works if one thing stays true. Most people don't ask for their money back at the same time, because here's the math nobody likes to say out loud. If every depositor tried to withdraw their money tomorrow, the bank could not pay them. Not because it's evil, because it's structurally impossible. Your money is tied up in long-term loans, 30-year mortgages, 10-year bonds, business investments that can't be instantly reversed. So the system runs on confidence, quiet confidence. As long as you believe the number on your screen is real, liquid, and available, it works. The moment that belief wobbles, things get ugly fast. That's why bank runs spread like panic, not logic. Once people realize that deposits are promises, not possessions, the rush begins. History is full of these moments. Banks didn't fail because they ran out of money. They failed because trust ran out first. Now here's where the irony kicks in. You are technically lending money to the bank, but you don't set the terms. You don't negotiate interest. You don't choose how risky the bank's bets are. In fact, in most countries, the interest you earn on your deposit doesn't even keep up with inflation, meaning the bank borrows from you cheaply and lends expensively. That spread is the business, and it's incredibly profitable. So why do people accept this deal? Because the system wraps itself in safety nets, deposit insurance, government guarantees, central banks as backstops. These exist for one reason: to protect confidence. In the US, deposits are insured up to a certain amount. In many other countries, similar protections exist. But insurance doesn't mean your money is sitting there waiting. It means that if the system breaks badly enough, someone else promises to step in, usually the government, which leads to the next uncomfortable layer. If banks fail at scale, governments don't magically have piles of cash either. They borrow, they print, they inflate. Losses don't disappear. They move, often quietly, often slowly, often into the future. So when you ask who owns my money after I deposit it, the honest answer is layered. The bank controls it. Borrowers use it. The central bank backstops it. The government guarantees a part of it. And you hold a claim, not ownership. A claim. This is why your bank account feels safe, until it doesn't. It's why limits exist on withdrawals during crises. It's why regulators panic when confidence drops. It's why the system spends enormous effort making sure you don't think about this too often. And to be fair, most of the time, it works. You swipe, you transfer, you withdraw. Life goes on. But stability isn't the same as solidity. It's balance. And balance depends on behavior. Zoom out, and this becomes less about banks and more about power. Modern money is not a thing. It's a relationship, a web of promises layered on top of each other. Your deposit is a promise. The loan is a promise. The insurance is a promise. The currency itself is a promise. And every promise assumes the next one holds. This is why financial crises are never just about numbers. They're about belief, about trust snapping under pressure, about suddenly realizing that the thing you thought you owned was actually a shared agreement with millions of strangers. So the next time you check your bank balance, don't panic, but don't oversimplify it either. That number isn't cash in a vault. It's a claim in a system built on confidence, timing, and restraint. And the real question isn't whether that's good or bad. The real question is this: if money only works because we all agree not to ask too many questions at once, what happens when enough people finally do?